Wall Street Week Daily segment. The host of Wall Street Week, David Westin, joins us as he does around this time. And of course, David, it's been a wild week in markets. And one thing that really dominated the conversation worldwide was everything that's going on in China.
Yeah, pretty much every day, right, Romaine? We heard something about China. It was not good news. So we decided to sit down with two of our contributors on Wall Street Week, Larry Summers of Harvard and Steve Rattner, Willett Advisors, to talk to Larry about where the economy is going in China, and to Steve about, for an investor, because he invests a lot of Mike Bloomberg's money over in China, what it means for investors. Starting with Larry and whether he's surprised at the weakening of the Chinese economy.
I thought for a number of years that the Chinese juggernaut was going to slow. Juggernauts usually do in economics. The classic examples were Russia in 1960 when it was seen as going to surpass us in 1980, or Japan in 1990 when people expected that it was going to surpass us. So it's a pretty good rule that when American high school kids rush to study a foreign language, that's about when the country's economy is peaking. So you've got that. Then you have a variety of near-term challenges of the kind you just referred to, financial strains in China coming from excessive reliance on real estate and the drying up of export markets. Then you've got some fairly profound adverse fundamentals for China. The fact that Chinese parents had only half as many kids last year as they did 6 years ago. The fact that there's large amounts of people with money in China who are very, very eager to get it out, which is always a sign of impending difficulty in emerging markets. So I would not be confident at all that China will be a faster than average growing major economy over the next decade. And that's obviously a big difference from the world we've been living with for the last 40 years.
So just a personal note, Steve, let the record reflect that Larry was right in his rule of thumb. I studied Russian in high school in the 1960s, so certainly here's one anecdote that supports you, Larry. So you've an investor in China. You spent a lot of time there. We're there fairly recently, actually. What do you make of what we're seeing right now?
Well, first of all, look, I have been more optimistic about China in the past, and I will say that I have recalibrated my views. I mean, it is definitely going through a tough period. I don't think I'm as pessimistic as Larry is. I would just mention, for example, that they may not make their 5% GDP growth number this year. Maybe it'll be 4, maybe it'll be 4.5. It'll still be probably twice what ours is. So I don't think we can yet sort of wipe China off the blackboard. It was clear on my trip there that the sanctions that we've imposed and the whole deglobalization phenomenon and the fact that business feels that they have to be more careful about their supply lines has taken a toll, and it's definitely affected their exports and their general mentality in their business. The second big problem they have is Xi, who has reasserted his control over the economy, who many of our investors that we talk to there feel doesn't really even understand economics. And you can, by their policy actions so far, I think you probably agree with that. And so you've got really bad government policy on top of a bunch of difficulties, whether it's the property sector, whether it's exports, whether it's whatever. But I would say I'm not completely going to wipe China off, because I think you have to recognize that you do have a lot of tools. For example, everybody talks about their debt. Nobody talks about their assets. The IMF just came out with a paper in the last few days that basically tried to look at the balance sheet, assets and liabilities of the Chinese government. And while their net assets have been coming down, they're still substantially positive. I think if you went through the same exercise for the U.S., you'd find a different result. Their central government debt to GDP is only about 30%. They have plenty of scope to do something on the fiscal side to both stimulate the economy as well as solve some of the problems that the provincial governments do have with debt, which are very meaningful.
Larry, if China continues to struggle economically the way they have, and Steve points out they're still growing more than we are, but still struggle compared to where they were, is that good for the United States and the rest of the world, or is it bad? Do we need a strong China economically or a weak one?
It's two-edged. It's good when your customer prospers, and it's bad when your competitor gets hyper efficient. So it's a two-edged thing. I am concerned that we will become the object of China's frustration, and that will tempt them to lash out. I think we need to be very careful in our approach to China at a moment of this kind of difficulty, and we need to be more attentive than I think some of the policy advocates in Washington are to avoiding a situation where we terrify China with the potential economic damage that we're going to do to them.